Welcome back to Multibagger Shares. I am Manish Goel, SEBI registered research analyst. Today we are going to talk about one of the most dangerous traps in the Indian stock market: dividend yield traps. Why high-yielding Indian stocks often destroy wealth, and the 5 forensic tests that separate sustainable dividend payers from silent portfolio killers. Every few weeks an investor sends me a screenshot of an obscure stock showing a dividend yield of 12%, 15%, sometimes 20%, and they write, "Sir, this looks like free money. Should I buy?" My answer is almost always the same. A dividend yield above 8% in the Indian market is almost never a gift. It is a warning siren. Let us understand why. The formula for dividend yield is simple. Annual dividend per share divided by current market price times 100. If a company pays 20 rupees in annual dividend and the stock is trading at 500 rupees, the yield is 4%. Looks like a safe bond with equity upside. But the mathematical trap is hidden in the denominator. A falling stock price mechanically inflates the yield. If that same stock crashes from 500 to 250 because earnings are collapsing, the yield suddenly screams 8% and looks even more attractive. But the next dividend will almost certainly be cut, and the yield you thought you were buying will never arrive. There are 3 classic anatomies of dividend traps in India. First, the PSU dividend mirage. Companies like Coal India, ONGC, REC, NMDC top the high-yield screens. But their dividends are often driven by the government of India's fiscal deficit needs, not genuine business strength. When commodity cycles turn or government policy changes, dividends get cut overnight and the stock crashes 30 to 50%. Second, the cyclical peak trap. Commodity-linked businesses like Vedanta and Hindustan Zinc pay massive dividends at cycle peaks. Retail investors rush in chasing the trailing yield. But commodity cycles are by definition mean reverting. When prices normalize, these companies cut dividends by 60 to 80% the next year. Third, the zombie business trap. The deadliest variant. Legacy textile mills, dying trading houses, certain PSU banks. Their earnings are shrinking every year. But the stock price falls faster than the dividend, which inflates the yield optically. A 12% yield on a dying business is not income. It is a countdown to zero. Now let me give you the 5 forensic tests that will save you from 95% of these traps. Test 1. The payout ratio sanity check. If the company pays out more than 80% of net profit as dividend, one bad quarter can force a cut. Sustainable payers retain 40 to 60% for reinvestment. Test 2. Free cash flow coverage. Net profit can be massaged, but free cash flow cannot. Look at the last 5 years of FCF. Total dividend paid must be comfortably covered by actual cash generation, not accounting profit. Test 3. The 10-year consistency test. A truly reliable payer has grown its dividend through multiple cycles. COVID, demonetization, GST, rate hikes. If the company cut dividends even once in 10 years, deduct heavy points. Cut twice, walk away. Titan Biotech's 14-year unbroken dividend track record is a gold standard example. Test 4. Debt-to-equity cross-check. A high dividend paid from a debt-laden balance sheet is a transfer of wealth from creditors to equity holders. Eventually lenders wake up, screen out any high-yield stock with D by E above 1. The best payers are net cash companies. Titan Biotech operates at a D by E of just 0.02. Nearly debt-free. That is the fortress balance sheet real dividend investors look for. Test 5. Revenue growth lens. If revenue is shrinking, The dividend is coming from a declining base. Terminal decline. Look for 10 to 12% revenue CAGR over 5 to 10 years. Now, why does this matter so much in April 2026? The market is near all-time highs. Nifty at 24,050. Sensex at 77,550. Retail investors flush with paper profits are rotating into so-called defensive income ideas. Every brokerage is pushing top 10 dividend yield lists. This is exactly the environment where dividend traps harvest the most victims at multi-bagger shares. Our position is clear. Dividend yield is a quality signal, not a return strategy. A 1 to 3% yield from a fast-growing, debt-free, high-ROE compounder is vastly superior to a 10% yield from a dying business. Titan Biotech's dividend yield is just 0.09%. Is that a weakness? No, it is the correct decision. The company is compounding capital internally at far higher rates than any dividend can deliver. A good business is the best dividend you will ever own. This ties into our anti-diversification stance. Warren Buffett said it best: wide diversification is only required when investors do not understand what they are doing. Scattering money across 20 high-yield stocks for safety is exactly the kind of unthinking dilution that destroys compounding. A concentrated portfolio of 5 to 10 deeply researched high-conviction businesses will always outperform. Finally, while some retail investors chase dividend traps, many more are destroying capital in futures and options. SEBI's study showed 90% of individual F&O traders lose money, with aggregate losses above 51,000 crore rupees in a single year. F&O is gambling. The only sustainable path to wealth in Indian equities is quality stock picking and long-term patience. If you want to learn the full 95-factor framework we use to evaluate quality stocks like Titan Biotech, click the link in the description for our complete value investing course on YouTube. Please like this video, subscribe to the channel, and ring the bell so you never miss a lesson. Join our Telegram channel at Long Term Equity Y for daily value investing insights. Thank you for watching. Remember, concentrate, research deeply, hold for decades. That is how real wealth is created in Indian equities. Jai Hind.